Hey guys, welcome back to Investing in Stocks for the Long Term. This is Tom. Today we're going to be looking at one of the most underrated investment books that I have ever heard of. Um, it's not even really mentioned among the standard list of, what should a new trader read, such as How I Made 2 Million in the Stock Market, Reminiscence of a Stock Operator, Beating the Street, etc., etc. Now, it is a relatively recent book. It came out about 7 years ago or something. Actually, not even that long ago, 5 years ago. Um, and it is Edward Chancellor's Capital Returns, Investing Through the Capital Cycle. Now, what this is edited Marathon Capital Management, which does have a really good track record. I don't have it on the top of my head, but they've definitely been beating the market. I can put that down in the comments, the exact track record. But what it is, it's their investment reports, their letters, edited into book form by Edward Chancellor. Now, Chancellor was known for his book, The Devil Take the Hindmost, History of Financial Speculation, which talks a lot about bubbles, and the South Sea bubble, the tulip bubble, Japanese speculative period, and everything. It was a bubble too, yeah. Anyway, so great book. I have not finished it, but I'll definitely be doing a review on it as well. Now, Chancellor studied history at Cambridge and Oxford in the 1990s. He worked for an investment bank, Lazard Brothers, and then contributed to various financial articles in papers like The Economist and the Financial Times. So, anyway, Edward Chancellor. Now, I'm going to just, before I get into this book, I'm going to let him explain to you in his own words kind of what his approach is.
Cycle is to look at where capital is going today, where supply is increasing. So to look at supply rather than demand, and see that changes in supply are what drive mean reversion in the world, in the world of business, and therefore in the world of investment, and that therefore, and to understand that investment returns are actually inversely proportionate to the amount of capital that is thrown at a problem, and that, in a way, it's a very simple approach, because what I'm saying is you should, with a capital cycle approach, is you spend 90% of your time looking at the supply side and only 10% of your time looking at demand conditions. And the reason you do that is that actually it's very difficult to project demand accurately. Now, for instance, China has been slowing, and all those people 3 or 4 years ago who had these projections of Chinese economic, they made these projections of let's say, 1 billion urban consumers, and then they would change the sort of the proportion. They'd have a sort of fantasy about what China's GDP would be, and then they'd have a fantasy about what China's consumption share of GDP was, and then they would work out
per capita,
what, how many cars will be demanded, and then you see current production, and you say, oh well, they're going to sell it. And this is, it's a very complicated process, all that, but it gives you a result that has no accuracy whatsoever. If you look on the supply side, you can see an industry, for instance, the Chinese car industry, where capacity is massively increased and is immensely fragmented. So if you focus on the supply side, you get better insights, which deliver more accurate investment results than if you spend your time thinking about demand. And the other reason to do this is that everyone else, most other investors are extrapolating in a linear fashion into the future, whereas a person who is adopting the capital cycle approach is actually the very term cycle is in the words. You're thinking thinking cyclically in a cyclical world in which your competitors are extrapolating in a linear fashion. So that in itself gives you a huge advantage. The other key distinction between the capital cycle approach and the and say conventional investing is that whereas conventional investing is often siloed into value and growth, is the capital cycle allows you in a way to be both a value and a growth investor.
Anyway, he goes on.
I mean, I'm sure you'll...
And I do hate to cut him off, but let me just get into his thesis a little bit more, just from the book. And I know you're wondering, is there academic research to back up the fact that what he said, as the new capital comes in and the asset growth goes up, does that actually translate into lower returns? And the answer is yes, it does. I've got a chart for you here. The high asset growth companies are underperforming. They're over here, the high asset growth, and then the low asset growth, higher performing. This was a man, Andrew Lappenthorne, studied this, and they found that as asset growth goes up, returns go down. This effect persists for about 5 years. So it's a very interesting idea. And yeah, it's not like no one's ever thought of this, but it was never explained to me the way it was explained so clearly in here. And just looking at the supply side, and then looking at where the competitive advantage comes in. Don't look at, am I a value investor, growth investor? It's really about finding hidden moats, and that's what we will get into. I want to break this up into separate videos because I know y'all have the attention span of a gnat, and you're probably just wondering why my chart is falling down over here. I just put this up just to look official, but no. So I'll kind of break it down chapter by chapter, but today I just want to go into quick basics of what the capital cycle is, and that pretty much is it. Now I will say that there are two big problems with the capital cycle approach, and he admits that he missed out on those problems. Number one is digital and other tech disruption. The supply side, there was consolidation and stuff like that when you got to CD retailers, Blockbuster, Kodak, and he admitted that he was caught in all of those industries. So you got to realize, okay, yeah, supply side, capital cycle, yeah, but is there something bigger going on? So you got to be careful of that. You've also got to be careful of the government. Is the government, lowering interest rates or propping up businesses that would go under? Is the culture such that you're going to continue to increase production even if it's not really in your economic interest to do so? And I will bring those things up again. I just had to get that in there. That's the weakness of the capital cycle. You've got to use it as a tool, not just blindly follow it. But quickly, I just want to give you a couple of examples of this overcapacity and then, sort of crash that we had. Now, number one would be telecom. Some of y'all may be old enough to remember how all the telecom companies went up during the tech bubble and then they crashed. They operated on the mistaken assumption that internet traffic doubling every 100 days, and they built out way too much capacity. It was called dark fiber, and the stocks underperformed massively for years. Another one would be the shipping industry. Daily rates for Panamax rose from 2001 to 2007, 10 times. Now, it takes about 3 years to build these dry bulk ships. And by the time they got built, the fleet doubled from '04 to '09. But right as they came on, you had slowing demand from China. And then you had a massive crash, 90% crash in the rates. And of course, housing, the peak of the bubble, stock of new homes was 5 times the demand. Spain and Ireland were up to 15 times. This was demographic projections, immigration. Obviously, it didn't work out. And he does talk about some of the reasons for why things get that out of whack. He talks about investment bankers, which he would know about since he was one. He says, investment bankers lubricate the wheels of the capital cycle, helping to grow capacity during the boom and consolidate industries in the bust. Their analysts are happiest covering fast-growing, sexy sectors. And now he also says higher stock turnovers equal more commissions. Now, we know it's a little bit different these days, but the overall point stands. And he goes on to say, bankers earn fees by arranging secondary issues and IPOs, which raise money to fund capital spending. Now, I like this part. Neither the M&A banker nor the analysts, the brokerage analysts, have much interest in long-term outcome. As investment bankers' incentives are skewed to short-term payoffs, bonuses, it's inevitable their time horizon should also be myopic. It's not just a question of incentives. Both analysts and investors are given to extrapolating current trends. That's how we get momentum. In a cyclical world, they think linearly. So you see how you get the overconfidence, and then the high profitability, or just for whatever reason the market's bidding up their stock to hot sector. You get the overconfidence. I think they're skilled. Then the media feeds on it, and then they make demand forecasts, which are usually wrong, and then you expand out, and then there's too much supply, and competitors follow. They're like, oh wow, we don't want to lose market share, and then sometimes CEO pay is set in relation to a company's earnings or a market cap, so they're incentivized to grow the assets. We've seen this a lot in the oil patch recently. That's why, aside from the fact that people don't want to invest in oil for environmental reasons, the capital discipline was terrible in a lot of these oil and gas stocks. So anyway, investing through the capital cycle, probably the most underrated book when it comes to sort of giving you a framework for understanding how to think about investing beyond just the evaluation or charts or consumer approach. Now, I certainly don't want to there are some other underrated investment books we will get into in another video, but I hope you guys made it to the end, and I'm going to continue breaking down this book because there's a lot of other good information in the rest of it. So until next time, peace out.